Welcome to 321 study, corporate reporting. This lesson will be discussing about regulatory and conceptual framework. Before we continue the study, I will let you know, that regulatory and conceptual framework is an integral part of the financial statement. When we say regulatory, without the regulators, we will not follow the dynamics, we will not follow the rules. But where there is regulator, they enshrine the rules like our code of ethics that talks about integrity, objectivity, professional competency and due care, professional competency, confidentiality. We deduce it from the regulators. The regulators of accounting profession, the highest body is IFAC. They regulate accounting profession and its members. So if that is the case, in performing the professional work, we need to follow the ethics of the regulators. We need to follow the standard given to us by the regulators. Therefore, I need to look at who are the regulators. How do we come about the accounting standard? Without the regulator, we won't be able to issue the accounting standard. So I will be taking you through the regulatory framework. When we talk about regulatory framework, I want to let you know the actors in the field of accounting. The first, we'll be looking at the IFAC. International Federation of Accounting Committee. International Federation of Accounting Committee is the highest professional body in the world. Every other professional body comes under IFAC when it comes to accounting and the likes. IFAC regulates matters that relates to auditing. ICAN regulate matters IFAC regulate matters that relates to taxation, that relates to strategic financial management, that relates to auditing, that relates to financial reporting, corporate reporting. IFAC is established in 1977 and situated in New York. They have enormous responsibility to ensure that we are well guided when it comes to taxation, we are well guided when it comes to auditing, we are well guided when it comes to corporate reporting. IFAC now take it as a responsibility by having separate professionals that will take care of each aspect of accounting profession. We have ISA, International Standard of Audit, issued by International Standard of Audit Board. But I'm not discussing that. What relates to our own course is IASB, International Accounting Standard Board, that issues IAS, International Accounting Standard, or IFRS. Before we get to IAS or IFRS, let me break it down. IFAC now appoints IFRS CF, International Financial Reporting Standard Committee Foundation, comprises of 22 members. IFAC dedicate them that you are the board of trustees that will be looking at how we issued accounting standard, how we regulate accounting standards, how you ensure that the whole world adopt IFRS and IAS. And with this mandate given to IFRS CF, International Financial Reporting Council Foundation, they were able to achieve a good milestone because more than 100 countries have adopted IFRS already. Their mandate is to issue global acceptable standard and influence national accounting standard setter to adopt IFRS. IFRS CF, International Financial Reporting Committee Foundation, now decided to bring on board IASB. They act as a trustee. IASB, International Accounting Standard Board, comprised of 14 members, will do the work by issuing standard. Remember, IFAC is a general regulatory body, mandating IFRS-CF to issue global acceptable standard and influence other national accounting standard setters to adopt IFRS, which I have told you it has achieved a great milestone. They go in turn to mandate IASB, International Accounting Standard Board, to issue global acceptable standard and update the existing ones. People will now be having issue with why we having IS, why we having IFRS. With the global convergence with IASB and Financial Accounting Standard Board of US, the both bodies now agreed to issue International Financial Reporting Standard. But the existing standard issued called IAS is still relevant from IAS 1 to IAS 40. But if there is any standard that doesn't conform with the current current economic situation, we will need to revise it. We need to now issue new one. When the new one is coming on board, it will now take the name nomenclature of IFRS. As you are aware, we have IAS 18 in the past, revenue recognition. Now it has been turned to IFRS 15, revenue from contracts with customer. That will be discussed in details when we go to that particular lesson. For now, we are looking at regulatory framework and conceptual framework. IASB will be advised on the need to issue new accounting standard or update existing one. Remember, their job is to issue international accounting standard, international financial reporting standard, and update existing one. So IFRS AC, International Financial Reporting Standard Advisory Council, comprised of 50 members, we advise IASB on the needs to issue new standard or update existing ones. Remember, IASB issue standard called IFRS, or in the past IAS. They are issuing it to the whole globe, to the whole generality, be it in medical line, engineering line, agricultural line, manufacturing line, any mention. If they are to issue those standards, they need to consult the experts like agriculture, understand the dynamics of how agriculture works, understanding the dynamics of how engineering company works. That is why we have International Financial Reporting Standard Advisory Council, comprises of both non-accountant and professional accountants. This body will be the one to advise IASB on the needs to issue global acceptable standard and update existing one. We have also a body called IFRS, International Financial Reporting Standard Interpretation Committee, comprises of 12 members. This body is mandated to give more interpretation, more guidance to the standard issued by IASB, to give clarity to standard issued by IASB. When an expert wants to use the standard, when an accountant wants to use the standard, IFRIC, International Financial Reporting Interpretation Committee, we issued full guidance on what the letters of the standard issued by IASB is all about. This is the regulatory framework. The moment you can take these charts, you will be able to understand and bring out points when it comes to regulatory framework. The next aspect we'll be looking at is the conceptual framework. Remember, the highest body is IFAC, which individual professional body in a nation signed to be a member. And when IFAC adopted them, the individual chartered nation comply with the directive of IFAC because IFAC is the highest regulatory body in the whole world. It relates to accounting matter, either taxation, auditing, financial reporting, name it. But the now mandated IFRS-CF, International Financial Reporting Standard Committee Foundation, to issue global acceptable standard and influence national accounting standard setter to adopt IFRS in totality, which they've achieved a milestone of ensuring that more than 100 countries have signed into IFRS. They go ahead to enact IASB. IASB will be the one to issue the global acceptable standard and update the existing one through an advice for International Financial Reporting Standard Advisory Council. Then IFRS, International Financial Reporting Interpretation Committee, will interpret any standard issue. But I need to let you know that there are stages, 3 stages. The standard setting process IASB will go through. The first one is for them to start a discussion. Discussion on the new standard with vote of 8/14 members vote in favor of that discussion. Take, for example, when we are talking about IFRS 16, Lease, you remember that we have IFRS IAS 17 that talks about lease. We have operating lease, we have finance lease, and in IAS 17, operating lease, if you lease an item of plant that is 10 years and you lease it for 4 years, under IAS 17, we call it operating lease because you lease it for a short period of time. But IFRS 16, updated one, says that we have contradicted the principle of asset and liability because assets is the resources currently controlled by an entity in which an inflow of economic benefits is expected to flow in. Are you informing us now that if entity control an asset for 4 years, that asset cannot be reflected in its financial statement? It must be reflected in its financial statement. But under IAS 17, it's off the financial position. You just expense it on yearly basis as you pay the rents. But now, in the lease agreements by IFRS 16, when you lease assets more than a year and you have the rights to the asset for more than a year, say 2 years or 3 years, that asset will be treated as finance lease. Because of the definition of assets. Assets is resources currently controlled by an entity. So what I'm trying to inform you is that debate, that standard came to limelight through a debate by 8/14 vote in favor of that debate. When the debates on that particular matter, that this IAS 17 that is talking that about lease of an asset that you lease for 6 years or 4 years, but you are saying it's an operating lease, and the economic useful life of the asset is 10 years. This contradicts the definition of assets because for the next 6 years or 4 years that you lease this asset, you have control of the asset. So IAS 17 is now saying, based on their debate and the final conclusion of the standard, you need to account for the assets account for the lease agreement as finance lease. Therefore, it means through their discussion, they will have what we call exposure drafts. Exposure drafts. In their discussion, we call it discussion paper. Discussion paper. We call it discussion paper. In the discussion paper, they will agree. Like I've used an example for you that IAS 17 needs to be revised so that we carry the correct treatment of asset and liability. By saying that if you lease an asset more than 1 year, say 4 years, 3 years, 2 years, you take it as finance lease, as an asset, then you recognize the corresponding liability. So if that is the case, the discussion paper, they will issue it through their websites or accounting journal for professionals to deliberate on this matter. So they sent it through their websites. Their websites, IASB websites, or through accounting journal. For those who are interested in accounting, lecturers, professors of accounting, scholars in the field, to make their input and comments. In stage 2, they will receive all comments. They will receive all comments and make general consensus based on popular opinion and issue what we call exposure drafts. The exposure drafts, after the rectification of comments they've received from members, scholars contributing to that standard, they will draft out an exposure draft based on the general opinion, and this exposure draft become a standard after 2 years of issuance. 2 years of issuance. It becomes a standard. So, in summary, IASB issue International Accounting Standard. Through this process, I've informed you. Somebody will bring up a debate. 8/14 will vote in favor of the debate to go on. After 8/14 vote in favor, they will discuss it, pass it through their websites in the second stage for interested party to comment on it. The moment interested party comment on it, they will issue what we call a special draft. It becomes a standard after 2 years of issuance. You are welcome to the conceptual framework. You agree with me, we said it's regulatory and conceptual framework. Prior to 2018, we have been using 2010 conceptual framework, comprised of 5 parts. 2018 also comprised of 5 parts, but there is a little rearrangement and details explanations as regards 2018. In 2010 conceptual framework, the reporting entity is under construction then. But now, the project is completed. We have 2018 conceptual framework. For the 2018 conceptual framework, we have 5 parts. We have the objective of financial statements. We have the objective of financial statements. The objective of financial statements is part 1. We have qualitative characteristics of useful financial information. And we have financial statement and the reporting entity as part 3. We have underlying assumptions as part 4. And we have capital and capital maintenance as part 5. When we talk about accounting concepts, we need to understand the basis. We need to understand what this wants to achieve. Conceptual framework. This is the foundation we place accounting standard on. We place whatever we do on in accounting profession. And I would like to let you know, when we say what is accounting concepts are the basis. They are the traditions. They are the rituals. They are the assumptions underlying the preparation of financial statements. Why am I saying that? When we inform you that something is conceptual framework, before you erect a building, there must be a foundation. That foundation is what you place your building on. So in accounting, our foundation is our conceptual framework. The conceptual framework brings about our standards, and our standard guides us on how to prepare the financial statements. So we'll be discussing this conceptual framework on part-by-part basis. The first part is objective of financial statements, according to 2018 conceptual framework. The 2018 conceptual framework informs us that the objective of financial statement is to present the financial statement fairly to the users of financial information. Objective of financial statement is of the financial information to be fairly presented to the users of financial statements in order for them to make predictory and confirmatory decisions. The P&L, statement of profit or loss and financial position, the cash flow, the statement of change in equity, the notes to the account must be fairly presented. For it to be fairly presented, the users, the stakeholders, who are the stakeholders? The shareholders, the loan note holders, the debentures, the government, supplier, and customers. They want to use these financial statements to do some appraisal, to do some analysis in informing them of the current position of the organization so that they will take an informed decision from the financial statements. If that is the case, they need to present this financial statement objectively. For it to be objectively prepared, it must be fairly presented for the users to make predictory and confirmatory decisions. For it to be fairly presented, it must be free from all forms of fraud or error. That is the reason why the conceptual framework is on principle basis. Principle based means you must conform in totality with the standard. But if what you are presenting in the financial statements will enhance the objectivity and is not in the standard that you are applying, use that what you are presenting. Use that basis you want to use to present that financial statement and make some notes to the accounts. Because what we need is principle based. It's not by rule based. That is the reason why if an organization financial director want to hang under one fact that the standard do not say we should do this, but the conceptual framework, which is our foundation, have told us that whenever you are presenting the financial statement, you must be objective. And for you to be objective, the financial statement must be fairly presented, free from error, free from fraud, free from any form of manipulation, in order for the users to make predictory and confirmatory decision. When we say predictory and confirmatory decision, we are talking about you assisting the users with the factual of the financial performance, with the factual of the statement of financial position, with the factual of the statement of cash flow and statement of change in equity, notes to the account, guiding them to make a balanced decision. For them to make a balanced decision, the financial statement must be fairly presented. We will now run through the qualitative characteristics of financial statements and the reporting entity, underlying assumptions, and capital maintenance The moment you understand these facts, that as a qualified chartered accountant or a professional student, the principle enshrined in our conceptual framework issued by International Accounting Standard Board 2018 mandated us to adopt a principle-based approach in our presentation of financial statements. By so doing, all what you need to put in the financial statement must be fairly presented. You must be objective in order to assist the users to make an informed decision. For them to make an informed decision, the financial statement must be fairly presented. For our regulatory and conceptual framework, we shall continue our next lesson of part 2 of this conceptual framework in the next lesson. See you at the next lesson. Thank you.